Welcome back to the Pro Ticker Podcast, everyone, your Wednesday morning edition covering major financial magazine headlines.
It's a wild one out there.
Yeah, it is a wild one out there this week. And as always, our listeners have handed us this really compelling set of articles and reports that we're going to dive into.
Yeah, a lot to unpack.
A lot to unpack. And I think for this deep dive, our focus is laser sharp. We really want to understand these significant market tremors that seem to be rippling out from President Trump's, these escalating tariffs.
They're making themselves felt.
They're making themselves felt. And, it feels, listener name, like we're at a pivotal moment.
It does.
Right? And we want to unpack what's really driving this volatility.
Yeah.
What are the smartest minds saying about where we might be headed? And I think it's so easy to get lost in the day-to-day headlines to the noise, right?
Absolutely.
So think of this as your shortcut to getting a comprehensive grasp on this complex and rapidly evolving situation.
Absolutely. I think that, that the level of market activity we're seeing in response to these tariffs
Yeah.
is quite significant.
Yeah.
And the array of sources that you've pulled together here from, the Wall Street Journal Market Watch to the detailed analysis from Bloomberg, it really offers a rich, multi-layered view
Yeah.
of the immediate impacts, the potential economic fallout,
Yeah.
and this interconnectedness
Yeah.
of the global financial system.
The global financial system. I mean,
Our goal here is to try to synthesize,
yeah.
these often competing narratives
Yeah.
into something clear and insightful.
Into a clear picture. So let's jump right in.
Let's do it.
Okay. So to the heart of the matter, right? President Trump's latest tariff offensive against China, and as MarketWatch reported in their piece, cell phones, clothes, TVs, toys,
The whole shebang.
the whole shebang, right?
Yeah.
These new levies have pushed the total cumulative tariffs on Chinese goods to a staggering 104%.
It's a big number.
It's a big number. It's
Yeah.
a big number. And, this wasn't a hypothetical threat.
No.
These tariffs went into effect right after midnight on Wednesday, April 9th.
They did.
So this is a concrete action, and the markets have reacted accordingly.
For sure. I think that, the immediacy of that implementation definitely amplified the market response.
Right.
And we saw both Bloomberg and MarketWatch highlighting this in their reports. Stocks slump with treasuries as tariffs kick in.
Right.
And, MarketWatch was also reporting that U.S. Treasury yields spiked as midnight struck.
Right.
So, we witnessed a broad sell-off in equities,
Yeah.
reflecting that initial shock and uncertainty.
Yeah. I mean, speaking of shock and uncertainty,
Yeah.
I mean, that dramatic intraday reversal that we saw on Tuesday really kind of underscores, this hair trigger sentiment
Yeah.
that's dominating trading desks right now.
Yeah. Everyone's on edge.
Everyone's on edge.
Nobody knows what to expect.
And that's what makes it so fascinating, right? I mean, because I think this is where things get particularly interesting, even a bit counterintuitive.
Yeah.
Typically when the stock market takes a hit, we expect investors to be flocking to the safety of government bonds,
Right.
driving their prices up and yields down. But as the Wall Street Journal pointed out
Yeah.
in their article, stocks are in turmoil, but Treasury yields are stubbornly high.
What's going on there?
I know, right? Long-term Treasury yields actually rose.
That's not what we would expect.
That's not the typical flight to safety reaction
Right.
that we've come to expect.
Definitely not.
So what's going on there?
So, yeah, I mean, this is a real head-scratcher, this unusual rise in Treasury yields during a stock market sell-off.
Right.
It suggests that, that traditional safety net
Yeah.
of government bonds, it might not be as reliable
Yeah.
in this specific scenario.
It's like the rules don't apply.
Yeah, it's like, what's going on?
Right.
So, both the Wall Street Journal and MarketWatch articles kind of touched on this.
Yeah.
And one potential explanation is that some bond traders are viewing this tariff escalation as a short-term shock. They're anticipating maybe a quick resolution
Right.
or a limited long-term impact.
Okay.
But there's also this concern about inflation,
Right.
which is, directly fueled by these tariffs.
Right.
Higher tariffs translate to higher costs for imported goods.
Right.
And those costs are likely to get passed on to consumers,
Yeah.
leading to broader price increases.
Right. So essentially prices go up
Because
because of the tariff. So the cost of these goods goes up.
Yeah, and that erodes purchasing power.
It erodes purchasing power.
And it can lead to, a slowdown in economic activity.
So it's not just the stock market we're talking about.
No, it's the whole economy.
The whole economy.
And then there's this other element
Yeah.
that MarketWatch was reporting on
Yeah.
in their U.S. Treasury yield spike report.
Right.
And this is a more technical element.
Okay.
They mentioned Jim Bianco's comment about a possible disorderly liquidation.
Oh.
So perhaps, hedge funds rebalancing their portfolios, unwinding positions in response to this increased volatility.
So it's like they're trying to get ahead of...
Yeah, they're trying to protect themselves.
And it sounds like the standard correlations and market behaviors we often rely on might not hold true.
Yeah, it's a different environment.
It's a different environment. And you know what this makes me think of is this idea of buy the dip.
Yes, buy the dip.
Right. And, this is something that the Wall Street Journal addressed directly in their piece, the dip buyers braving the market during stocks carnage.
There's always somebody out there.
There's always somebody, but, that historic intraday reversal we mentioned earlier caught a lot of those dip buyers completely off guard.
Yeah, it was a wild ride.
It was a wild ride.
So, it's a real debate right now. Is this time different?
Yeah.
Will the fundamental impact of these tariffs be persistent enough to prevent the market from bouncing back?
From its typical rebound after a downturn.
Exactly.
It's like, will it bounce back or we're in a new reality?
That's the million-dollar question.
And yet, despite all these cautionary signals, individual investors have actually been pouring money into ETFs and equity funds.
Really?
Yeah, and this is according to the Wall Street Journal.
So they're not scared?
They're not scared. They're not scared at all.
Interesting.
So what's going on there, right?
Yeah. I mean, are they showing remarkable resilience?
Yeah.
Or are they underestimating the potential depth and duration of this market disruption?
That's a really good question. Listener and letter, what do you think? Are they being brave or are they being foolish?
I mean, it's tough to say. It's a complex question.
Yeah.
As the Wall Street Journal article pointed out, there's definitely a segment of the market that adheres to Warren Buffett's principle.
Right.
Be greedy when others are fearful.
Yeah.
And historically, that approach has often been rewarding.
It has.
But, the sheer scale of these tariffs, the potential for further escalations, and the interconnected nature of the global economy.
It's like a domino effect.
Yeah, it really introduces a level of uncertainty that could make past market patterns less reliable.
So past performance is not indicative of future results.
Exactly.
And, it's not just the traditional stock and bond markets that are feeling the repercussions.
Right.
Bloomberg had this really interesting report. ETH leads latest crypto sell-off.
Oh, wow.
Yeah, so the cryptocurrency market, which is often seen as somewhat detached from traditional finance, it's not immune.
It's all connected.
It's all connected.
Wow.
Right? And Ether in particular experienced a significant sell-off reportedly influenced by this tariff news.
Interesting.
So it really underscores the widespread nature of these market jitters.
It's like a ripple effect going out.
It is a ripple effect going out.
Touching everything.
Touching everything. And that interconnectedness of global markets is on full display.
It is.
And so we have to consider what the economic experts are saying.
Yeah.
What are the implications?
For the big picture.
For the big picture. And the sources that you've provided indicates that the level of concern is rising.
Yeah, people are worried.
People are worried. So Bloomberg's report, Stocks Slump with Treasuries as Tariffs Kick In. They highlight some really significant shifts. Yeah, and economists at major institutions like J.P. Morgan and Goldman Sachs are increasing their assessed probability of a U.S. recession.
Because of the tariffs.
Directly attributable to these tariffs.
Wow.
So that's a notable escalation of concern.
That is.
From some of the most closely watched economic forecasters.
Definitely something to pay attention to.
Definitely. And, within Goldman Sachs, there seems to be a little bit of a divergence of views.
Oh, really?
Yeah. So, as Bloomberg reported in Goldman's Flood, sees buy the dip returning. John Flood, who's a market strategist at the firm, suggests that long-term investors might start seeing compelling buying opportunities for the S&P 500 around the 5,000 level.
Okay.
With potentially even more aggressive buying kicking in if it drops into the mid-4,000s.
So he's seeing a potential bottom.
He's seeing a potential bottom, but then you've got the perspective from the technical analysts.
Oh, yeah.
And as outlined in Bloomberg's, traders seek elusive market bottom
Charts.
The charts, right?
Yeah.
They're painting a more cautious picture, focusing on key technical support levels like
Yeah.
4,910 and 4,835
For the S&P 500.
for the S&P 500. And their analysis suggests that if we break decisively below those thresholds, we could see further significant downside pressure.
So buckle up.
Buckle up.
It could be a bumpy ride.
It could be a bumpy ride. So this elusive market bottom
Remains elusive.
remains elusive. We don't know where the bottom is.
No, and technical analysts, they're looking for concrete signals
Yeah.
that the selling pressure is finally abating,
Right.
that capitulation.
Right.
But as long as the uncertainty surrounding the tariffs persists, those technical signals can be unreliable.
Right.
And, we also have Ed Yardeni's liquid nitro analogy,
Oh, yeah.
which Bloomberg included in their Goldman Flood
Right.
report. And he's suggesting that, the administration's aggressive tariff policies could have unpredictable and damaging consequences.
Ooh.
So, liquid nitro, it's powerful,
It is.
but it can be dangerous.
It can be dangerous if you don't know what you're doing.
Exactly.
And he also raises the possibility of a Fed put.
The Fed put.
Right.
So that's the idea that the Federal Reserve might feel compelled to intervene
Right.
to support the markets.
If they experience a significant decline.
Yeah, because they don't want to see a crash.
Right.
They want to maintain stability.
They want to maintain stability. And so this brings us to the relationship between the financial industry and the Trump administration.
Right.
And the Wall Street Journal had this really insightful article, Big Bank CEOs Reckon with Their Lack of Influence on Trump.
Interesting.
And it appears that the CEOs of major financial institutions, historically they've served as advisors to administrations on economic matters.
Right.
They feel like their input
Yeah.
is not being given the same weight this time around.
So their influence is waning.
Their influence is waning. So what's particularly striking is the contrast to past economic crises, like the pandemic or the 2008 financial meltdown.
Right.
In those situations, there was a lot of collaboration
Yeah.
between Washington policymakers and the leaders of the banking sector.
Right.
But this time, there's a palpable sense of uncertainty
Among these CEOs?
among these CEOs about the administration's goals
Right.
with these tariffs, and they're worried about the negative consequences
For the global economy.
for the global economy and, by extension, their own businesses.
Of course.
And, we're hearing reports of business deals being put on hold
Yeah, because of the uncertainty.
because of the uncertainty. And, of course, the rising specter of a recession raises concerns about potential loan losses for these institutions.
Yeah, that's a big worry for banks.
That's a big worry for banks. So the Wall Street Journal article specifically mentions that while some administration officials, including Treasury Secretary Yellen, have reportedly reached out to Goldman Sachs for feedback, other attempts by bank CEOs to engage with the president directly on this issue have been less fruitful.
Less fruitful.
And, there's an anecdote about Commerce Secretary Howard Lutnick essentially telling them to fall in line.
Oh, wow.
Right? So it highlights a disconnect
Between the administration.
between the administration and the financial industry
On trade policy.
on trade policy. So, on one hand, you have these concerns from the CEOs, and then on the other hand, you have Peter Navarro,
Oh, yeah.
who MarketWatch describes in their article. Peter Navarro is the architect of Trump's tariff policy.
Right.
He's the key driver,
The mastermind.
the mastermind behind this trade strategy, and he's urging investors to remain calm,
Stay calm and carry on.
still calm and carry on. And he's even predicting a stock market boom,
A boom.
a boom,
Wow.
as a result of these policies.
That's optimistic.
That's optimistic, and it stands in stark contrast to the recession warnings.
Yeah.
We're hearing from JP Morgan and Goldman Sachs, and then you have critical comments from figures like Elon Musk,
Oh, yeah.
which were also mentioned in that MarketWatch article, and it highlights this really deep division in opinion
About the likely economic outcome.
about the likely economic outcome. So you've got people saying the market's going to boom, you've got other people saying we're headed for a recession.
It's a wide range of opinions.
A wide range of opinions.
And, Navarro's perspective,
Right.
it's been well documented
Yeah.
in his past writings.
Yeah.
And, the broader policy blueprints, like
Mhm.
Project 2025.
Right.
And it reflects this long-held conviction in the necessity of these tariffs
Yeah.
to address trade imbalances
Right.
and bolster American economic strength.
His background is fascinating, too.
It is.
I mean, including his recent legal challenges.
Yeah.
It adds a really unique dimension
See his role.
to his role in shaping trade policy.
Yeah, he's a controversial figure.
He is a controversial figure.
Mm.
So now let's shift our focus to the global implications. China's official reaction to these latest tariff hikes is obviously a crucial piece of the puzzle.
Of course.
And MarketWatch, in their article, China calls for trade talks with U.S.,
Okay.
reported on this. And while Beijing is calling for renewed trade negotiations, their underlying perspective on the entire trade relationship appears to be fundamentally at odds
With the U.S.
with the U.S.
So they want to talk, but
They want to talk, but they don't see eye to eye.
They're not on the same page.
They're not on the same page at all. So what's really important to understand from that MarketWatch report is China's assertion that they've consistently adhered to international trade rules
right,
and are not deliberately pursuing a trade surplus.
with the United States.
With the United States, they're arguing that the structural issues within the U.S. economy are a primary driver
Of the trade imbalance.
of the trade imbalance, and they explicitly state that they have honored the commitments
Under the Phase 1 trade deal?
under the Phase 1 trade deal. And while they're saying that they've honored their commitments, they're pointing to what they perceive as shortcomings
On the U.S. side?
on the U.S. side
In fulfilling its obligations.
in fulfilling its obligations. So it's this back and forth.
Yeah, they're both pointing fingers.
They're both pointing fingers.
It's a blame game.
It's a blame game, and their argument that the trade balance is largely a natural outcome of the global division of labor.
Okay.
Using examples like Apple and Tesla, where design and innovation happens in the U.S., but manufacturing is concentrated in China.
Right.
It's a direct challenge
The U.S. narrative.
to the U.S. narrative, and their criticisms regarding U.S. policies on technology transfer and agricultural commitments paint a picture of a relationship where both sides feel they have grievances.
Yeah. It's a complex situation.
It's a complex situation with a lot of history.
A lot of history.
And this fundamental divergence in how each side perceives the trade relationship makes any resolution incredibly challenging.
Yeah, it's hard to see a path forward.
It's hard to see a path forward when you're not even looking at the same map.
Exactly.
And the tangible impact on global trade is becoming apparent
Yeah.
as MarketWatch's cell phones, clothes, TVs, toys article detailed.
Right.
The economies of the U.S. and China are deeply intertwined.
They are.
And these tariffs have the potential to drive up prices on a vast array of consumer goods
That American consumers buy every day.
that American consumers buy every day, from smartphones and apparel to electronics and toys.
Yeah, the things people need.
Things people need, and the reality is that many of these products are no longer manufactured domestically
In any significant quantity.
in any significant quantity, and rapidly identifying and establishing alternative supply chains is a complex and time-consuming process.
It's not easy to just flip a switch
It's not easy to just flip a switch.
and move production somewhere else.
So it seems inevitable that American consumers will start to feel the pinch in their wallets.
If this continues,
If this continues, and the potential doubling of costs on certain Chinese imports could exacerbate existing inflationary pressures
Yeah.
within the U.S. economy.
And potentially slow down growth.
Slow down growth and, looking beyond these broad consumer goods,
Yeah.
Bloomberg's report, Trump tariff turmoil will hit client wealth,
Okay.
delves into the consequences for the luxury goods sector.
Luxury goods.
Luxury goods.
Interesting.
And analysts in the space are suggesting that the negative impact on their high net worth clientele
Right.
from the broader market turmoil
Yeah.
is a more immediate concern than the tariffs themselves.
Oh, wow.
So their clients are losing money in the market,
Right.
and so they're less likely to buy luxury goods.
Makes sense.
And we've even seen some downgrades issued for certain luxury goods companies.
Oh, wow.
Based on these concerns, however, there is a notable exception.
An exception.
Yeah.
Hermes.
With their exceptionally strong brand loyalty
Right.
and pricing power, they might be better positioned to weather this storm.
So they're more resilient.
More resilient than some of their peers, and it's a reminder that even within an industry facing headwinds,
Yeah.
there can still be pockets of resilience
Or potential outperformance.
and potential outperformance. So it's not all doom and gloom,
Not necessarily.
but it's just definitely a mixed bag.
It's a mixed bag for sure.
And we're also seeing impacts on industries and economies beyond the U.S. and China.
Right.
Bloomberg reported on Tata Steel's plans for job cuts in the Netherlands.
Yeah. Tata Steel to cut 20% of jobs in Netherlands.
And this is a stark example of how the broader climate of economic uncertainty
Which can be exacerbated by these trade tensions
can lead to difficult business decisions and workforce reductions
on a global scale.
on a global scale. So these tariffs have far-reaching consequences.
They do.
And on a completely different front.
Yeah.
Bloomberg also had a report, Justice Department scales back cryptocurrency enforcement. Yeah, so it seems they're scaling back their broader enforcement efforts and prioritizing specific criminal activities
Within the crypto space.
within the crypto space, rather than focusing on more general regulatory violations.
So they're being more targeted.
More targeted in their approach.
Interesting.
And this could signal a potentially evolving landscape
For the digital asset industry.
to the digital asset industry.
Okay.
So finally, let's turn our attention to the Federal Reserve.
The Fed.
The Fed. How might they respond to this growing market turbulence
Right.
and the increasing risks of a slowdown?
Yeah, what they can do.
What are they going to do? MarketWatch's article, What the Fed Could Do as Stock Market Rout Spreads, explores some of the options.
Okay, lay it on me.
So as that piece suggests, the Fed might have initially preferred to take a wait-and-see approach
Right.
to address the consequences
Of the tariffs.
of the tariffs, but they could be compelled to act sooner.
Due to the market volatility.
Due to the market volatility, especially that rise in longer-term treasury yields.
Yeah.
That's a red flag.
It's a red flag. So MarketWatch outlines a couple of potential responses.
Okay.
The possibility of an emergency interest rate cut,
Okay.
which the market is already starting to price in,
Right.
and the implementation of temporary bond purchase programs,
Okay.
similar to what the Bank of England did in 2022
Oh, yeah, with the gilts.
with the gilts.
After the mini budget.
After the mini budget,
Yeah, that was a mess.
that was a mess. And that comparison to the Bank of England's actions is instructive
Yeah.
because it shows how a central bank can step in to stabilize a specific segment of the market
Without abandoning their broader policy goals.
without abandoning their broader policy goals like fighting inflation.
Yeah.
And the Fed could also choose to focus on the short-term funding markets.
Right.
The article mentions the declining SOFR swap rate,
Yeah.
which can indicate concerns about liquidity
In the financial system.
and a reluctance among banks to lend to each other.
So basically, banks are getting nervous.
Banks are getting nervous, and they're not lending to each other as freely.
And any signs of dysfunction in these critical plumbing
A
systems
financial market,
would warrant attention from the Fed.
for sure.
So to bring our deep dive to a close,
Okay.
it's clear that these escalating tariffs have created significant turbulence across global financial markets.
Yeah, it's been a wild ride.
We're seeing a broad sell-off in stocks, unusual behavior in Treasury, yields anxieties among economists about a potential recession, and a really diverse range of reactions and predictions.
Experts and investors.
From experts and investors, China is calling for renewed trade dialogue, but holds a fundamentally different perspective on the trade relationship, and the ramifications for global trade flows and consumer prices appear to be substantial.
Yeah, there's a lot at stake.
There's a lot at stake. Even seemingly unrelated sectors like luxury goods and cryptocurrencies are feeling the ripples.
Yeah, it's all connected
It's all connected, and the Fed may be considering how to respond
to these pressures.
to these pressures. So it's a period of heightened uncertainty with a multitude of interconnected factors at play.
It is.
So this situation has direct implications for your investment portfolio.
Right.
The prices you pay for everyday goods
Yeah.
and the overall health of the economy.
Absolutely.
So understanding these different perspectives, the risks and the possible policy responses
It's crucial.
is crucial for navigating this evolving landscape.
Couldn't agree more.
And given these conflicting signals we're seeing across different markets, the potential for significant market shifts and the uncertainties surrounding the tariffs, what new questions arise for you about your own financial strategies or your outlook on the future of global trade? What specific sectors or indicators will you be paying close attention to as this situation unfolds?
Yeah, those are great questions to be asking yourself right now because this is a really dynamic situation.
It is.
And staying informed and engaged
Yeah,
is going to be more important than ever.
it is. So we'll see you all tomorrow morning,
Bright and early.
bright and early, with new headlines from major financial magazines.
Sounds good.
See you then.
See you then.